Hopefully all the best is coming to you. Just gotta stay true, don't sell out without a doubt. Yeah, alright, so, alright, okay, something new for the day, bringing massive value as I would say. Come what may, cause you never know just how it go. One day might be sun, one day might be snow. So just go with the flow.
Thank you. You're also tremendous.
Alright, so what I'm going to talk about are the 7 money psychology mistakes that people make while investing. Now, I'm sure there's like a different set that I could come up with for, saving money, or a different set I could come up with making money. But I don't look at investing as saving money. Saving money is just keeping it, not doing anything to it, right? And then you take that money you save and then you invest it. So basically, these are the 7 most common money mistakes when it comes to investing. I want to provide this knowledge to people so that they can make more money and they can be more successful. So yeah, I'm going to go through the list of the 7 different mistakes people can make. And the first one is a confirmation bias. The second one is the illusion of control. Third one is a mental accounting bias. Fourth is a recency bias. Fifth is herd mentality. Sixth is loss aversion. Seventh is overconfidence. So yeah, basically, I'll break it. If any of those sound not familiar, like the terms or anything like that, if you want, go ahead and stop the video and you can Google that stuff. But I'm gonna explain it as I go through each one. So the first one is the confirmation bias. And that's basically that people are going to pay more attention to the information, stimulus, the output, whatever you want to call it, the matrix, whatever it is, however you look at life. People will pay more attention to anything that really confirms what they already believe, and they're gonna pay less attention to any information or any stimulus that goes against what a person believes. So a person, and this is not everybody, because once you understand this concept and you're aware of it and you have that awareness that this is something that happens, naturally without even thinking about it, you can become more aware when you're doing it. So awareness is really the key to stop awareness is really the key to preventing any of these mistakes, is becoming aware of it while you're doing it, and then over time you can become aware of it before you're even doing it and stop yourself from doing it. So yeah, basically, look at investing. You're looking to invest in a business, you're looking to invest in a bond or whatever it is, and you're going to do research, and you're going to try to find things that really support that you're right, that really support that it's going to be a good investment. And that's easy to find, because anytime there's something to be invested in, there's going to be people putting out information that are going to try to convince people to invest in that and why it's a good idea. But yeah, a lot of times what happens really is, people will only search out for the things that confirm that they're right. And not only that, but people will see something that they want to see that will support their original conclusion. So even though something might not have anything to do with what they're investing in, their mind will start seeing like coincidences that will make them think that it's a great time to invest in this. And it might be totally unrelated, might be totally out of line with investment strategy, which is like basically a whole different video, kind of like rules you would have when it comes to investing or trading. So yeah, it's just something that not a lot of people are aware of. Confirmation bias. The next one would be basically the illusion of control. So I think for investing, the illusion of control most applies to people who use tools and instruments, not only with, price charts and stuff like that, but metrics within a company, or even people who know somebody within that organization or company or whatever it is they're trying to invest in. And, having these extra tools, having this extra insight into something will maybe cause a person to think that they have an upper hand, that they have more control over the next person, which I guess, the only people I think this is really true for are people who work within the company or politicians. Those are the people that you hear about that get caught doing the insider trading schemes and things like that. But at the end of the day, there's probably so many more people that, thought they were going to get away with some insider trading, but the investment, even though they had all the knowledge, the investment didn't turn out like they thought it would, and they didn't make money or they lost money. So really, people will try to, think that because they have some upper hand, some form of control when it comes to information that they can't fail. But that is clearly not the case, because a lot of people have more information than the next guy, but they still end up making a losing bet, making a losing investment. A mental accounting bias happens generally when somebody is overly risky with money to spend or invest. And basically that happens when most often when the money that's being invested was kind of like easy money or fast money, or money that was made through another investment that worked out really well, but it made it seem like the money was like so easy to make, right? Let's say a person invested in Tesla at the beginning, and then they got hundreds of thousands of dollars in profit a few years later, and they look at that profit like, oh, this is all just money that I can put in like risky investments now, because it was like free money. But that's how a lot of people end up losing it, just like with a business, right? Like someone gets a business going and they get it started and it's doing really well, and then they go and they split their time and efforts and money into like 5 other new ventures, and they really disregard the one that got them the success in the first place. And they think, well, it was so easy to do that first one, I'm just going to expand this overnight to like 10 different locations, or start another like 2 or 3 more businesses. And then, they end up just using all the money from the business that was working, that they neglect, to put into businesses that don't work and end up failing. So there's that same thing that happens across many different levels when it comes to money and mindset. Basically, the best way that is advised to people who have this problem is to take that money that they generated that might easily be wasted, and instead of investing it back into a cash investment, actually buy some kind of asset that appreciates in value. Okay, the recency bias is recency, like as in like recent, like something just recently happened, and that's looking at taking kind of current events, things that have happened in the short term, and using that as a basis on a decision. And that's definitely what's going on right now. I think if anything, this is going to be the most important lesson out of these 7 lessons that I'm talking about right now. But basically what's going on right now is for the most part, the entire market, like the stock market, a lot of different markets, are way down. Even though a lot of these businesses are still making close to the same amount of money they're making a year ago, their stock prices are down like 50 to 80%, right? So the business fundamentals are still there, but the entire stock market has gone down a lot in the past year. So people will see that recently it's gone down, so they're gonna say, well, if prices have gone down that much, then this must not be a good company. But the truth is, this could possibly be the best best opportunity to invest in these certain stocks and businesses that you would get in your lifetime. And when the price is really up, which I'm going to talk about in the next concept, people are way more likely to want to buy and invest in something. Even though the best time is obviously buy low, sell high. But people's mindsets can catch them in a trap to where all they want to do is buy something when it's high and sell it when it's low instead of buy when it's low. So yeah, a lot of people are not even buying into the market right now because they think it's going to crash even more. But these are the same people that were buying when it was, a year ago and everything was up 100% over the past year. But yeah, this is a very common thing that people would want to be aware of when it comes to investing. Next, you got herd mentality. This is what I was talking about with, basically it's called FOMO, fear of missing out, right? People will see something that's gone up 100% in a short amount of time, and they'll think it's going to go up another 100%. And they would rather buy, like their mind is gonna trigger them to want to invest in something more that's gone up, say 50 or 100% in a short amount of time, than something that's gone down 50 or 100% in a short amount of time. Even though the exact opposite, you want to buy when it's gone down, is going to be how you win in this game and how you get more money. And it's really, at the end of the day, I really think a lot of this comes down to abundance and scarcity mindsets. But that's really, I feel like, more of an advanced concept that I talk about on this channel all the time. And I know myself, it took many years for me to even really, after hearing about the, scarcity, abundance stuff, I just thought it was like fake, right? I thought it like sounded good at first. It took many years for me to really believe it. And then it took many more years for me to even really start to understand it. So I feel like for the basis of this video, it's better that I just, bring the level down a few levels to where, everyone can really understand this. And then once what I'm talking about right now makes more sense, then it can become easier to understand the bigger picture. So yeah, the solution to this problem is really to look at things from a wider perspective. Look at things from more of like a 5 to 10 year perspective instead of like just over the last year. There's always going to be another bull market. You never jump into a bull market that already happened. You just have to have that in mind. There's always going to be new opportunities. Just because you might have missed the opportunity that's being hyped up right now on the internet or on television or the news, it doesn't mean you should get into it and like make a quick decision. It's much better that you get in at times like right now with the stock market where everything's really low. You basically got to jump on the trends before they happen. And how do you do that? You start to become more conscious of trends in your life, right? Start to watch the trends, start to watch the business trends, start to watch the money trends. And over time, it starts to make more sense. Loss aversion just basically talks about how to avoid losing more money than you should, having a plan, right? Because if you go to an investment, you want to have a plan like, okay, if you go into an investment, you want to have a plan before you go in as far as, whether or not you're gonna get out of the investment. If you can, know whether you can even get out of it in the first place, and then set up like, okay, if this goes down, say 10%, I'm getting out of it. If this goes down 20%, I'm gonna get out of it. But a lot of people don't do that. A lot of people get in, and then what happens is, say it goes down 10%. They don't set a rule already that, they're gonna sell it at that. And what happens is people would rather watch something drop in price, watch their investment lose value, than to cut their losses. Because there's always that hope that, the price is gonna go back up. What I was talking about at the beginning, where people always want to feel like their decision is the right decision. So even though they might see their investment value going down, they're just gonna, in their mind, tell themselves that they're right and it's gonna come back up. But the most successful investors and money managers would tell you that that's the exact opposite way to go about winning in this game. That what you want to do is have a plan set up ahead of time, because some investments you get in, I mean, you're not gonna have every investment be a winning investment. Some you get in are not gonna work out, so you got to know how to get out. Last law I'm gonna talk about is overconfidence. I mean, the best thing I can say about this is really just to be aware of, the path you've taken and the wins that you've had and the losses that you've had and how much time it took you to prepare for these wins. So yeah, at the end of the day, you can move in the right way. So hopefully you got some value off of what I had to say. Trying to bring you new information with no delay. Go ahead and hit the like button if you haven't already. Trying to come through with new information steady. Go ahead and subscribe so you can be in tune with the information to thrive. No joke. Hope you get some hope.